7 fascinating facts about the broad-based S&P 500. 1. Originally, it didn't contain 500 companies. A little more than 61 years ago, on March 4, 1957, the S&P 500 we know today took shape. Back then, as it is today, the index was comprised of 500 companies. But the S&P 500 hasn't always tracked 500 companies. When it was first introduced in 1923, it was simply known as the Composite Index and tracked the performance of a relatively small number of companies. This was expanded in 1926 to include 90 stocks, which was the number it stuck with until its expansion to 500 companies in March of 1957. 2. There's been a lot of turnover, yet many familiar faces remain. As you might have rightly imagined, there's been quite a lot of turnover in the S&P 500 since March 1957. An S&P Dow Jones Indices committee is responsible for reviewing and replacing companies in the S&P 500 on a regular basis to ensure the index reflects the dynamic nature of the U.S. economy as closely as possible. According to a Bloomberg report from March 2007, 50 years after the modern-day S&P 500 came into existence, there were 86 original members still remaining. Though this figure has likely fallen over the past 11 years thanks to mergers, acquisitions, bankruptcies, and removal decisions from the committee, there are still dozens of companies that have been a part of the S&P 500 for more than 61 years and counting. Examples include Coca-Cola, Merck, Pfizer, PepsiCo, and Kroger, to name a few. 3. Technically, there are more than 500 stocks included in the S&P 500 right now. Here's a weird fact to share with your friends at parties. Technically, the S&P 500 tracks more than 500 stocks. Though the index is limited to 500 companies, some companies have issued more than one class of stock, meaning the index tracks 2 or more of these classes. As of July 2018, the S&P 500 actually tracked 505 stocks. As an example, in 2014, Google, which is now known as Alphabet, Google 0.72%, Google 0.59%, issued a new class of stock. The pre-existing Class C shares, GOOG, have no voting rights, while the 2014 issued Class A shares, Google, have 1 vote per share. 4. There are stringent criteria for inclusion in the index. Though the committee has the ultimate say on what companies are included and removed from the S&P 500, there are some pretty clear guidelines for inclusion. The selection criteria include a market capitalization in excess of $6.1 billion. Annual dollar value traded to float-adjusted market cap is greater than 1.0. Minimum monthly trading volume of 250,000 shares in each of the 6 months leading up to committee review. Must be a publicly listed company on a major U.S. exchange, no over-the-counter, OTC, stocks. Certain securities are ineligible, such as limited partnership, master limited partnerships, OTC stocks, preferred stock, royalty trusts, and exchange-traded. 5. Its 10 largest components comprise more than 21% of the index. Even though the S&P 500 doesn't fall victim to the uselessness of price weighting, it's still heavily influenced by a relatively small number of components. As of July 5, 2018, the largest 10 components accounted for more than 21% of the S&P 500's weighting. Apple, 3.924345%. Microsoft, 3.300070%. Amazon.com, 2.947227%. Facebook, 2.049400%. Berkshire Hathaway Class B, 1.553777%. JP Morgan Chase, 1.520523%. ExxonMobil, 1.500398%. Alphabet Class C, 1.469428%. Alphabet Class A, 1.467526%. Johnson & Johnson, 1.443485%. Fact number 6: the S&P 500 has undergone 36 corrections since 1950. While we often think of the stock market as a wealth creator, it's worth noting that downtrends and corrections, defined as at least a 10% move lower from a recent high, actually happen quite often. According to data from stock market analytics company Yardeni Research, the S&P 500 has undergone 36 corrections since the beginning of 1950, or about one every 2 years. Though bear markets are less common, just 3 in the past 36 years, downside in the stock market is inevitable. Yet, interestingly enough, 22 of these 36 corrections have found their bottom within 104 days or less. Only on 7 occasions since 1950 has a correction lasted longer than 288 days, and it's only happened twice since 1982, the dot-com bubble and the Great Recession. In other words, corrections, while common in the S&P 500, tend to be short-lived. 7. It's a model of long-term consistency. Last but not least, let's look at the other side of the equation, the S&P 500's long-term consistency. Despite being prone to corrections every so often, at no point would an investment in the S&P 500 for a period of 20 years have produced a loss. What's more, with the exception of the correction that occurred earlier this year, all previous 35 corrections since 1950 have been completely erased by bull market rallies. In short, the broad-based S&P 500 has demonstrated that patience pays off over the long run,